our take for the budget 2025-26. So if you look at the biggest impetus in this budget has been the tax cuts. There is a hope with these tax cuts it would revive slowing urban consumption, which could have a multiplier effect and could boost growth. So that's the underlying assumption that we have seen in this budget, a hope to revive a slowing urban consumption. Next, what we have seen is from a Capex standpoint, we have seen some slowdown in Capex spending. So if you look at FY24, it was pegged at 7.1% of GDP. Last year it came at 6.7%, and again for the next year it's pegged at 6.7% of GDP. So it's slightly lower from a Capex standpoint, but the way the Capex was structured has seen a distinct change. Earlier it was more infra-led push that was happening from a Capex standpoint. This year it's been marked towards more labor-intensive industries like SMEs, etc. So if you look at announcement like what happened for the toy or footwear industry or the credit mechanisms for the SME industry, it's more geared towards creating employment at the SMEs and therefore higher income for many people, at the same time addressing the job challenges that we have. So I think that's wisely done as compared to what we have seen previously, because that was not yielding the results in terms of creating employment and therefore incomes for people. So that's that. They have maintained the Capex spending, but if there is, say, a revival in economy led by consumption, that could lead to higher growth and that could lead to tax buoyancy, because if you look at the GDP growth has been maintained or it's more realistic at 10.1% for the next year, and if there is any improvement that could lead to more tax buoyancy and lead to higher income for the government and therefore their ability to spend more. So we will have to wait and see if that pans out the way it's been thought through. Also, if you look at from a rural economy perspective, the spending overall in rural economy from a rural agri and welfare spending perspective, it is higher than what we saw from a revised budget estimate. It is 32% higher than the revised estimates, but it is about 5% higher as compared to the original budget estimates. So what does this mean is there has been small increase in spending, and if it comes through in terms of total, it is a significant higher increase. But if you look at the way the increase has been structured, it is more geared towards subsidies and farm procurement, etc., as opposed to the direct transfers that we had seen through Manrega, etc. So that means that there is not going to be direct transfer, there is going to be an indirect support to rural economy, which does not assure us of consumption increase. So we'll have to wait and see again from a rural standpoint how that's picking up. We have seen some green shoots in rural economy. And there is not much support, so we don't know if that momentum will continue or not. So overall, it's been a good budget in terms of not going overboard. It's been prudent from a spending perspective, and there is some balance between consumption and capex probably is something they have tried changing, and hopefully it works for the economy. So what does this budget mean for an investor? From an investment standpoint or investment perspective, what does this mean for investors? So overall, if you see, it's been a cyclical slowdown which we have seen in the Indian economy, which is leading to the correction of the overvaluation that are prevailing in the Indian markets. And one needs to understand that budget can do only so much. So there is a try and attempt to put in some impetus in the economy, but it may not be enough. However, if you see the heightened economic activity that we had seen for the previous 2-3 years is leading to some slowdown on a higher base. And GDP being pegged at 10.1% is more realistic and should recur post then. So these economic support that the government has announced in this budget from a consumption and capex standpoint will take its time to work through the economy, and we should see some throwing of growth in the current year. And as it moves, markets will acknowledge and start moving up if there is growth that picks up going forward. So from that standpoint, probably markets may see some correction going forward because still the valuations are a bit expensive. And if that corrects, it would give an opportunity for investors to keep accumulating in the correction that we see. So hopefully investors' prudent approach would be to continue their SIPs and continue accumulating if there are any corrective opportunities that arise in the market. And also the tax benefit that investors would see because of the cut down in slabs of income tax, that would yield slightly higher incomes for people, and hopefully that would be spent wisely in terms of moving a bit of it towards investments through SIPs, and it would be a great opportunity from a investment standpoint and also utilizing the benefit that one would have received. Also importantly, for young people who would be entering their workforce, they'll have substantial benefit when it comes to tax savings because of the changes in slabs, and hence one could start their investment journey more earlier as opposed to starting it significantly later on. So I think this is a great opportunity for people to not only consume a bit more, but more importantly utilize that higher income because of savings on income tax to put it work in SIPs, in equity mutual funds. So hopefully this budget has given an opportunity for people to invest wisely, and hopefully they will kind of take that advantage to their stride. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.